All right. Good morning, everybody. Welcome back to another episode of the Tim and Tim Show with Making Moves in Multifamily Live. Glad to have another Tuesday on the books. And this week, we're talking about interest rate trends and how it's affecting our investment strategy. Let me be completely transparent and honest here with you up front. It's not just our investment strategy, it's the market's investment strategy. A lot of the things that we are going to talk about might seem like common sense because if you're in the real estate world and you communicate with a lot of real estate related people, it's kind of a resounding answer across the board of the metrics of how interest rates are affecting property values, refinances, acquisitions, exits, and everything under the sun, right? Interest rates are a huge needle mover for the real estate industry as the bank is your largest investor, typically giving you somewhere between, it used to be up to 80% leverage. Now it's as low as 50% leverage and anywhere in between that. So, the bank being your investor at a certain interest rate is your largest investor. So clearly having your interest rate and your borrowing costs change from your biggest lender is going to affect your property values, your cash flow, your return on investment. Everything really comes back to real estate leverage in the grand scheme of things. So, with that, we'll just jump right into it. Tim, what do you think about how the Fed paused rate increases as of January 2025 and are really uncertain today about where rates could potentially go with everything that's happening in the economy right now? I mean, there's a lot of news articles coming out about tariffs and immigration and Fed rates and inflation and Doge, Department of Government Efficiency cutting all the wasteful spending out, and how's that going to impact? I mean, there's so many different things that are moving right now. So, Tim, where's your head at in the grand scheme of things with where we're at today?
Yeah, so the Fed paused rate decreases, right?
Correct.
Um, yes. So I got to be honest, like this doesn't surprise me. After the election, Tim, if you remember, you and I had a conversation. I said I thought I'm concerned with what this is going to do to rates.
Yeah. Yeah. No, yeah,
And
you definitely called it when that happened.
yeah, this doesn't surprise me at all. I'm a little concerned on where we're heading in the next 12 to 18 months. A lot of people are like, oh, I'm worried about the next 4 years. I'm really not worried about the next 4 years. I'm worried about the next 12 to 18 months, right? Because that's going to be the piece that you got to get through, right? Like all of us that have refinances coming up in the next, just say 3 to 12 months, right? My whole strategy on that right now is like, if it's time to refi and put yourself in a position to hold, uh, because of the uncertainty that you just mentioned, all the different things, right?
Hmm.
Because one of the things that I have a strong concern about is, you mentioned Doge, and I think there's this idea that everything that we're going after is wasteful spending. Um, what I'm concerned with, and I'm not going to get political one way or the other. When that tends to happen, you tend to get a very skewed viewpoint, right or left, of what's wasteful spending.
Hmm.
So, it's going to be a very politicized piece. And to me, what that says is there's going to be a whole lot of um, just uncertainty all the way around. The whole thing is going to be just a period of uncertainty. And when I see that coming, I'm just like, okay, let me put myself in a position to ride this out. Um, so that's where my head goes right now. Um, I'm not, somebody asked me the other day, like, what are you, what are you doing? What they say, they were like, what are you doing to prepare for the next year or 2 years, and how's that changing your investment strategy? I'm like, it's not. I'm like, I'm doing what I need to do for the stuff I own, right? To put it in a position. But as far as my investment strategy goes, my investment strategy has always been, it's always time to buy.
Hmm.
It's always time to buy. And I'm as aggressive as ever right now on looking for things to buy.
Yeah.
Uh,
I
so
I think that with when you look for properties the way that we do with like a value add strategy, we are specifically looking for properties that are below market rent where we can force the
right.
appreciation and the value. Where it has created a bit more buying power for us is there's less competition because there's less people buying right now. And usually what you have is, as the interest rates go up, you have the cap rates go up as well, which, if you don't know, cap rates going up is not a good thing. It's not favorable for you. It's a decompression in your cap rate, meaning your property becomes less valuable. Um, this has created some opportunities for us because when we are negotiating deals now, we can talk more so about lending costs and going in cap rates and cash flow and ROI and things like that. Because the only way to meet our investor expectations are to reduce the purchase price, right? Or we bring less equity to the table. So what we've found is a lot more willingness from the other side of the table to hold seller finance notes in a second position, to come into the purchasing entity as like a class A position, which is in our world, or at least into the way that we structure deals, is an interest only position with no equity attached. And what that does is it reduces the amount of equity that we have to bring to the table so that our equity level returns are still good, um, because we're essentially buying with higher leverage, right? And that cost of capital can still be calculated and understood that our total cost of capital, you don't want to be higher than your NOI, right? Because if your cost of capital is higher than your NOI, your debt service is more expensive than the money that you're making. Therefore, you're cash flow negative overall after debt service. And the debt service piece is very, very, very important because that is such a huge dictator in your overall return on investment, right? In cash flow. What we have not seen a whole lot is change in NOI because let me rephrase. The NOIs on properties have remained strong. There have been increases in insurance and taxes, which prices have been adjusted accordingly. However, when we go through a refinance, we're not typically capped out on our LTV or loan to values. We're typically capped out on our DSCRs and our cash flow, and that is a pure arrow pointing at the increased borrowing costs, making it more difficult to service your debt. And as it becomes more difficult to service your debt, you can't take out as much leverage, and that's the only way to get your debt service down, right? So by reducing your debt service leverage, and then you therefore have to increase your equity that you're bringing to the table. It's a good place to be on an equity basis because you have a lot of equity in the properties, but your returns ultimately go down because you're bringing more equity to the table for less return, right? So the only way to get your returns back up at that point is a price reduction. And sellers know that, and everybody in the market knows that. And it's made it less difficult to have difficult conversations about why they're asking too much money for a property,
Right.
because you just point to taxes, insurance, and debt. And in 2020, 2021, 2022, you could literally throw spaghetti against the wall and make money in the real estate
Right.
industry because everything was great. Interest rates, like the Fed rate, was near zero. I think it was 0%, or if not zero, very, very, very close to it. So borrowing costs were ridiculously low. So you could get a lot of leverage and make a lot of money. There was a kind of a lag in the property taxes because the taxes hadn't been reassessed for the new property values, thus increasing your property tax bill, right? Reducing your NOI and reducing your value. And then there was a huge increase in insurance because of replacement costs. Inflation caused, materials to go up, labor to go up. Everything went up during COVID, 2020 COVID, and for probably likely 18 months to 24 months after COVID, which put pressure on your NOI. So those properties now that we're buying have been price adjust. I like to say they've been price adjusted for 2025. They've been reduced for in-place taxes. They've been reduced for what I would say is more stabilized insurance costs, significantly higher than they were, but they're now stabilized. I mean, we can more accurately predict where our insurance quotes are going to come in at, which is a good thing for pro formas and underwriting deals and establishing future value and things like that. But the biggest thing that we really can't put a pin on is what is going to happen with interest rates. And it's the number one
Right.
question everyone seems to be asking.
Yeah. And well, let me ask you this, Tim, though, because this is always an interesting question. Um, do you stop buying because of interest rates?
No, but and that's
Yeah.
exactly, you got to get creative, right? You
Right.
either get the seller to work with you on holding some equity in the deal as a debt position,
Yep.
increasing your leverage, negotiate on the rate and things like that. You do a price reduction. I mean, that's the hardest thing to get across. People are more willing to give you seller finance note than they are to reduce their price. And as a seller myself, I will much more gladly give you seller financing than reduce my price because, if you're not aware, it's essentially locking in capital gains today, and I can't access the money for a little while, but at least I'm collecting interest on it. But it's kind
Yep.
of a nest egg for later that I know is coming. I've already realized those gains. That's profit that I've booked.
Yeah. The reason, yeah, it's kind of a softball. The reason I asked that question is first to get it out of the way, right? Because I can tell you, and Tim will tell you the same thing. I can tell you how many conversations I've had with guys where you go through this whole thing about your buying criteria and everything, and they're like, "But interest rates, right? But interest rates," and it stops them, right? And so and then they say, "But how do you buy with these interest rates?" And it's like, listen, the interest rate's just a factor, right? It's just one factor in the deal, and as long as the deal works at the current interest rate, why wouldn't I buy it, right? And then you're still doing like Vitali's talking about here. You're still doing the standard stuff you do in your underwriting. And like you're not assuming interest rates are going to go down typically, right? We can all bet on that, but who knows? you know,
Who
ask
knows? Yeah.
a- ask
The safest
everybody.
thing you can do now is underwrite to where the rates are. Because I will say, I think we're kind of in a safe
Yeah,
zone where, rates could go down 50 basis points, rates could go up 50 basis points.
right.
And if 50 basis points on your debt service absolutely destroys your
Here's
deal,
your deal, right?
it wasn't worth doing to begin with.
Yeah. So, what I tell folks all the time is like, listen, as long as the deal works, I'll buy it. I don't care what the market looks like. If the deal works in the current market, I'll buy it.
Yeah.
As long as you're doing what Tim's talking about and you're adding in those safeguards in terms of your underwriting to make sure that when you buy it 3 years from now for something drastically interesting to happen, you're still okay. Now, listen,
Mhm.
full disclosure, guys, like we were putting safeguards into our underwriting in 22, right? 2022, the market's far outpaced those safeguards, right?
Mhm.
Um,
But it did
now,
work in our favor when we bought some stuff in 2021 where
yeah,
we modeled increased insurance rates, we modeled a
right,
decompressed cap rate. What we didn't model was how aggressively the rents were going to grow. So
right,
our expenses ended up going higher than what we anticipated, and our cap rate on exit was higher than what we anticipated. But what made up the difference between the two was our top line revenue was significantly higher than what we had thought. So that worked out for us in our favor. But to Tim's point is in some of the deals that we acquired in 2022 and 2023, we put those same safeguards. We followed our rules of thumb. We talked about exit price per doors and where the rents could go and things like that. But the number one thing that has really kind of jabbed us in the side is those insurance costs. I mean,
right.
nobody in their right mind would have tripled insurance costs ever. Nobody.
Yeah. So with that same thing in mind, like we started this conversation with, we're talking about tariffs and all these reductions and things like that within the economy. What I'm more worried about than interest rate, guys, is I don't know where inflation's going to go. I don't know what my expenses. I'm more worried about the economy or the reality outpacing our assumptions on expense
Hmm.
than I am interest rates right now.
Yeah.
If I'm being completely honest.
Yeah, the biggest thing that we've seen increases. I mean, we've had some adjustments on the utility costs. We've already seen a big change in the tax and the insurance. The next one that it really is not putting up not having any signs of relief, payroll. Payroll's not going down. Payroll and we've had to adjust a lot of our payroll numbers of what we're budgeting to hire people at and what our prices per unit would be based on the size of the property because what we used to hire for somebody at I'm not going to put dollar ranges there, but what we used to hire somebody for, we're not getting those quality people anymore, and we've experienced a lot of turnover. So we've had to increase that salary range five, maybe $10,000 to attract somebody that's worth their salt to be the property manager on site at the property. And ever since we've done that, we've had a lot better increase. We've seen less stress on the property because the good manager, despite costing more, they're making the property more money. And operationally, it's far more efficient for somebody
Yeah.
like that to come in and do well for the place.
Yeah. So, that's one piece. And then the next piece, folks, is like over the next, if you're going to dive into something right now, I would be telling you to really go dive into how to lower your cost of materials, how to get some sort of scale pricing on your cost of materials, because material costs are likely to go up.
Mm-hmm. Yeah,
Because I
especially
mean,
with the tariffs on, proposed on
well,
Canada and Mexico, a
well,
lot of lumber prices are projected to go up.
yeah, but it's not just the tariffs that impact that, right? Like the
Mm-hmm.
cost. I mean, has anybody tracked the cost of oil lately? Um,
Mm-mm.
so I can tell you, my Exxon stock is doing tremendously well.
Is it really?
Oh yeah, yeah, I've more than tripled my my purchase there. Um,
Mm.
Cost of oil is going up, guys. When
Well,
we
you bought it
start,
in the 80s, Tim. No, I'm just kidding.
when we buy, guys, when you get things like the war in the Ukraine going on, and you got things going on with Russia, and we're starting to talk about having a little bit of a pissing match with Canada and stuff like that, guys. We get a lot of oil from those places, so
Hmm.
oil is going to go up. When oil goes up, that naturally increases the cost of goods because we use a
Yep.
lot of oil all over the place, not in just shipping, but in actual production of our materials. So,
Yep.
uh,
Plastics and all that stuff.
well,
Oils and
lube,
everything.
plastic,
Rubber. Yeah.
everything. Yeah.
Everything.
Um,
Yeah.
if
Man.
you guys haven't watched it, the show's kind of dramatic, right? But Landman, there's a
Oh,
scene
yeah.
where
Have you watched that?
there's a scene
I
where
want to watch
Billy
that.
Bob's standing at an oil field talking to the lawyer, basically explaining to her everything that we use oil in.
Yeah.
And you're sitting there and you're like, damn,
Mm. Right.
like, so it's
I need
pretty
to
cool.
own me some oil fields in Texas.
No kidding. Yeah.
Um, yeah, so all of these things affect, right? I mean, there's so much stuff that affects property values, interest rates, and overall mindset and sentiment. I mean, I have to say, a lot of people that we know in the market are kind of in a wait and see mode, which we clearly don't agree with. I mean, we make
Yeah.
numbers work for where we need to be at today, and if it works, we buy it. And hopefully some things will really start to go our way in 2 to 3 years, and we look like geniuses because we made stuff work today that nobody else was willing to take the risk on making it work because of the uncertainty in the interest rate environment. I would say that this is a golden opportunity for you to go out and buy as much stuff as you can. When there's uncertainty in the market, you need to lock in long-term financing and wait. We just finished a refinance, and Tim said it best we had a group text, and it was like, we just bought ourselves 5 years to get through this whole thing that's going on right now. We reduced our monthly debt service was what, $20,000 a month, 18, $20,000 a month.
Yeah.
And now it's what, $13,000 a month or something like that.
Something like that. Yeah.
We just freed up $6,000 of free cash flow by locking in our interest rate for the next 5 years, letting the market do whatever the market's going to do. And sure, the deal hasn't gone exactly the way that we wanted to, but let me tell you, you get 5 years down the road, and we've been paying down this debt and amortizing it, and we got all these, the cash flow has been pretty good over the life of it. And you bought this at such a good time before the next boom, you're going to look like a genius, right? So
Yeah.
it's a difficult conversation to have with your investors. Don't get me
Oh
wrong.
yeah.
Like, everybody wants to get paid now. But real estate is not a get paid now scheme. And does it create some level of cash flow? Yes. But the major payday is in the equity, right? In the property values going up, the rents going up, in amortizing the debt, like all of that. That's where you really make your bacon. So if you have the opportunity to make a deal work today with today's interest rates, do it, because it's
Yeah.
only going to lock in future profits. When things start to stabilize and investor confidence comes back, that's when everybody's going to hit the market again, and those cap rates will start compressing again.
Yeah. I tell people all the time, Tim and I talk about this a lot. Like,
Almost too much. I'm almost tired of talking about
man,
it.
yeah, we talk about it a lot. This is our lives, guys. When everybody's like, "Ooh, I want to do this," it's like, really, because we have a lot of boring conversations. But they're they're very critical.
I know my wife's eyes glaze over when I start talking about real
I
estate and
know,
interest
man.
rates. She's like,
Your wife and
"Why do I care?"
Yeah, your wife and my wife should talk. We walk the dogs, and she's like, I start talking, and she's like, oh.
You fell asleep while we were walking.
Like I'm like, I was gonna ask what you want for dinner. She's like, oh, I just assumed.
Oh yeah, yeah, yeah.
But no, guys, like seriously, if you ask me what rates are gonna do, I'm like, I don't know, but I do think the chances are good over the next 5 years that they'll trend down at
Yeah.
some point. At some point,
Historically, property values continue to go up over time. I was on Twitter and somebody posted a photo of like a brokerage statement from like the 90s.
yeah.
And you know what the cap rate and price per door they transacted at was?
No. Oh, let me guess, like 7,500. I mean,
It was price per door average in the 90s. They didn't talk about what market or anything like that. Price per door was around $15,000 a door, and the
wow,
cap rate was 14.83%.
nice,
But,
nice.
what they're not telling you is what were the interest borrowing costs at that time, because sure,
Oh,
cap rate might have been trading at 15, but if your debt was 12 or 13% for stabilized, it's no different than where we're at today,
oh yeah, yeah, yeah,
if
yeah.
you think
And
about it.
see, that's but think about that. Like Tim, really good example. Debt was like 12. Just say debt was 12, right? People right now are freaking out over 7,
Yeah.
right? But
Well, who were the
hindsight
old
being what
time
it
you were
is,
talking to some old timers once, and you were like, "Man, we were buying stuff and the interest rates were 10%. We were still making money."
yeah. But think about that for a second. If you had that same conversation and you said, "Hey, look at that property today," would you go back in time and pay 15,000 a door and pay 12% interest rates, knowing what you know today about what that property's worth? Right?
Everybody would. Everybody
Everybody
would.
be like, "Yeah,
Of course.
yeah, right,
Right. Right.
right." Like Tim, I was when my wife and I were looking for a house on the lake, we came across one that was built in 90, I think it was like 94, right?
Mhm.
And I looked at what they paid. They paid like $182,000 for a lakefront property,
We bought
right?
every single lakefront property you could buy.
That house was on the market for 1.9 billion, And
Jeez.
I'm like, who wouldn't go back in time and buy that house, right?
Right.
At that
Yeah.
time.
Yeah.
Uh, yeah,
Real estate over the long run will take care of you.
right. Yeah.
But, you have to think about the people that were transacting in the 80s and 90s. Think about the interest rate environment then. I mean, there was so much uncertainty with wild inflation, right?
Right.
Them making decisions then at a 15% cap rate and $15,000 a door is no different than us making a decision at a 7% cap rate with 7% interest and $100,000 a door. The
Yeah.
problem is the same. It's the mindset and the mental wherewithal to make a good decision, or scratch the good part, make a decision, because most people suffer with uncertainty and indecision, and
Right.
buy something if it makes sense for you today. 20 years later, you're gonna be like, damn, why didn't I buy everything? Like, think about the stuff that we were looking at in like 2020, Tim, or 19,
Yeah.
2019, 2020, like 80, 70, 80, 90, $100,000 a door. Those properties now are what, 150, $170,000 a door. And at the time, we're like, oh man, I don't really see if I can make this work. It's like, but everybody, 5 years later looks back and they're like, oh man, I wish I had that opportunity to buy this 5 years ago. Well, be that person today. You have the opportunity right now with this uncertainty. This is the clearest indicator that the uncertainty today is your buying metric that you should go buy, and go out there and buy as much stuff as you can. If it services the debt and pays your investors, you'll be fine.
I would rather be in this market right now than where we were in 2022. Um,
I want to be selling in 2020. But I want
yeah, as a buyer, I would rather be in this market right now.
as a
Um,
buyer, yes,
yeah.
absolutely. But
So
I mean, we go ahead.
so when people ask, "Are you buying?" I'm like, "Hell yeah!" Like I like this market better because for a couple of reasons. One, because it's just Tim and I saw a deal last week where somebody grossly overpaid 2.5 years ago, 3 years ago, grossly,
Hmm.
and I'm not going to talk about the specifics of the deal. I'll just say that they're not going to get anywhere close to what they paid, right? Nowhere
Nope.
close. Really unfortunate situation. But they overpaid because everybody was overpaying, right? They got caught up in location, they got caught up in with trophy asset and all this other stuff, and like it's going to be worth this because of where it sits, right? And everybody was guilty of that, guys. I mean, I'm not pointing the finger at one in particular person, but at the end of the day, this market right now, that buyer havoc doesn't seem to be there right now, and it actually allows Tim and me, quite frankly, because we've been looking at some stuff lately, to just sit back and when people bring us an offer and just be like, I don't see it. Like I'm willing to pay this, and this is what I'm willing to do right now. And if that doesn't work, there will be other deals to do. And that's another thing too, is I have 100% confidence there will be other deals to do
Hmm.
because there's a lot of stuff coming out right now. There's a lot of stuff being pitched behind the scenes, being pitched off market that people are just trying to sell. And I'm like, I don't have to go overpay somewhere
No.
else just to get my hands on a property. I don't have to. It's just unnecessary. I really like this market right now from a buyer side as opposed to 3 years ago.
You know what's funny? And I'll say this, maybe somebody out there is going to disagree with me. I've never felt more calm in the underwriting process and the offer
Mm,
process. This level of confidence and calmness because I don't have to do this. I don't have to buy this deal. I don't have to push my assumptions to make a deal work. If it doesn't work clear as day with conservatism built in, I don't have to buy it and I'm not going to. Because to your point, Tim, there I know that there are more opportunities coming and I would love to own this asset. Trust me, I would love to. But if it doesn't work, I'm not going to force it to work because I've got a large enough portfolio already which we can make far more efficient and make a lot more money off of without adding anything to it. And I know that there are going to be more opportunities. It's February 4th, people. And we've had three, four, five maybe deals come to our plate in the last, that's basically one a week of,
yeah,
hey, these guys need to sell this. What will you pay for it? We're in February. It's not even March yet, not even the end of the
yeah,
first quarter. I mean, it's only going to continue with this uncertainty in the debt markets and people running out of extensions. It's only going to be more opportunity on the table to buy. And I am not willing to stretch my expenses and stretch my employees and stretch the cap rate in order to make a deal work. I'm like, no, I'm going to make sure that this place has people that are paid fairly, that are
yeah,
paying living wages, that are going to want to come to work because they're getting paid to do so fairly. And I'm not going to, compress my cap rate and pipe dream that, these things are going to continue to trade at, five caps or less,
yeah,
just won't do it.
yeah. And guys, Tim said one thing that I know somebody's going to pick up on because I used to challenge people on this when I first started is yeah, but you guys have a portfolio already, right? You don't have to be aggressive because you have stuff, right? It's like don't let where you currently are force you into a poor decision, right? Like
Right.
you just got to be patient, right? You have to be patient.
Hmm.
Um, and that doesn't and the truth of the matter is, guys, is as long as you're still networking, as long as you're still connecting, as long as you're still reaching out and pounding the pavement, you'll find a deal. I promise you, you will find a deal that works.
You're
Um,
doing the repetitive activities that Tim and I are no more successful than anybody else. We've just been doing the same repetitive tasks for a lot longer time period.
yeah,
Which
and
is
guys,
connecting with investors, connecting with brokers, underwriting deals, analyzing the markets. Like
yeah,
literally what we're talking about right now, this is what we do on a weekly and monthly basis so that we have an understanding of what's happening today, what's happening in the future, and that just continues to build our education and overall knowledge basis of the industry that makes us even more and more and more successful over time. Everyone says, "Oh, them old guys they've been doing it their whole lives," right? Well, they got their whole lives worth of experience and knowledge now. So you don't get that by just waking up one day and being old. Like you got to do the same boring steps every single day and just stay in the life and do it. That is growing your business if you like to think about it that way or not. Those are all the things that grow your business. Acquiring deals is not the only way to grow your business.
yeah, man. Two quick shout outs last night. I had dinner with Dennis Polson and David Booty.
Oh, David
Last
is down there too?
he came over.
Oh,
He
nice.
lives.
Oh,
He's
that's right.
only
Yeah,
like
yeah, he
45.
quit his W-2 job. Yeah, so he's
Yeah.
he's in Mobile.
That's funny, Mel. You're
Ha!
impatiently patient.
I'm
Hey, Mel,
impatiently patient.
Mel got in a deal recently, man. Congrats, brother.
I think I saw that post on Facebook.
Yeah. So, but back to Dennis and David for a second. Like those guys, you know, I'm gonna throw a little shout out for a second here. Those guys joined our Making Moves community, what, a couple years ago now?
They were like the first people to join.
Yeah. So they've been in, they've been doing things. And one of the things I always saw with those two guys is they're like, I'll do this, I'll do this, I'll do this. They were the first to raise their hands. They were constantly pounding the pavement. And those guys have like, David's closed on a ton of stuff. Dennis has been closing on stuff. And they've kind of gotten to the point now where they're like, they've got deal flow coming in. I sat and listened to David talk about the things they're looking at last night. They got deal flow like you wouldn't believe. Dennis's deal flow is picking up like really, really well. And it's just really cool to watch because they've done and they're doing exactly what we're talking about here is
Mhm.
they've just stayed consistent and they've been patient. And like you say, Mel, they're impatiently patient. They're patient enough that when They're not going to do anything dumb, and when the right thing comes along, they're ready to pounce on it.
I was just going to say that, like, all
Yeah,
of the things that they've done leading up to that point makes it so that when they do find something to make a decision on, they feel confident to do so.
yeah. And man, it was so cool to sit and talk to those guys and listen
Oh,
to
I
them. Like,
believe.
dude,
Yeah.
they're so like David, man, he's so sophisticated now. Like he
Oh
was
my God.
talking through debt assumptions and like
Yep.
grants and all this other stuff. Like, wow.
Yeah.
Like,
And David
wow.
will be the first person to tell you he joined our group because he wanted to learn how to become a better underwriter and understand the business as a whole. He was a pipe welder and
Something,
lived,
yeah.
he pulled his camper around the country with one of them big diesel dually trucks and had a welder on the back, and he'd go to the job site and so don't judge a book by its cover, right? Anybody can do this if you dedicate your time. You dedicate your intentful with your time, right? And you're
Yeah.
consistent with your time over a long period of time. Yeah.
Man, I just gotta say, I just sat there and I was so happy to hear the stuff that he was talking
But
about because
what my favorite part, Tim, is they're no longer like our students. They're our
oh no.
peers. You
Shit. I
become a
asked
peer at a certain point in time.
Man, I call Dennis once a week, maybe every
Do you
other week
really?
at
Yeah.
least. Yeah, and ask him a question. Like I ask him things
Yeah.
like, hey, Dennis, what do you think about this?
Right.
Um,
Perspective and knowledge. It varies person to person. And it's a beautifully amazing thing. And there is a certain level of pain that you have to go through to become, to go from student to peer. But once you get there, it's like you can never go backwards.
yeah, yeah. He those two, man. Big shout out to those two guys,
Yeah.
for sure. So
Yeah. So, anyways, all right, we went a little overtime today. I know interest rates are something that everybody likes to talk about, hot topic. Hopefully, you got a little bit insight about how Tim and Tim think and what we're doing today, how that's going to impact our tomorrow. Because I guarantee you, 2 years from now, when everybody's like, I can't find a deal, and Tim and Tim got all the deals, they're like, oh well, you guys, had the opportunity to do it 2 years ago. You have those same opportunities to you today. Make sure you're using the leverage that you have in your favor. And right now, uncertainty is the leverage that you have. So leverage that and go out and do some deals because you can, because you're worth it and you should. And
yeah,
take that level
yeah.
of risk. No risk, no reward. Thanks, Joe. Appreciate it. All right.
All right,
Peace.
man. Peace, guys. See ya.